South Africa's Business Daily website published an article on August 23 titled "The United States and China Symbiotic Relationship Ensures That Neither Side Will Destabilize the Other." The author is Mike Dolan. The full text is excerpted as follows. The US and China may think that the current détente in financial relations is wise, even though mutual stimulus works well at home. For all the talk in Washington of decoupling, or de-risking, the world's two largest economies are so closely linked that the consequences of destabilizing the other are dangerous, even if politically required. This interdependence or desire for it is far from what it was a decade ago, when China was rapidly integrating into the world economy. In 2023, geopolitical tensions are unsettling, and both sides begin to impose investment restrictions, trade restrictions, and supply chain adjustments. But the once feared binding factor of mutually assured financial destruction still applies. For example, Chinese entities still hold more than $1 trillion in U.S. treasuries. A sudden cessation of support for each other, effectively crippling U.S. and Chinese demand, does not seem to make sense, at least economically. More than a decade ago, former U.S. Treasury Secretary Larry Summers added an F, financial, to mutually assured destruction, MAD, on nuclear issues, making it mutually assured financial destruction, MAFD, reflecting the symbiotic trade and financial relationship between the two economic powerhouses. The web that binds them together involves U.S. import needs and the investment flows that fuel China's rapid growth and dollar surpluses, which Beijing spends much of its accumulation on U.S. treasuries. Everyone gets something out of it. The United States had new markets and investments, and a new, seemingly durable creditor nation that kept U.S. borrowing rates low and stimulated consumption. China gets cash inflows, export-led growth, overseas technology, and a destination for savings. While potentially as stable as a mutually assured destruction nuclear deterrent, Summers said at the time that mounting U.S. government debt exacerbated Washington's vulnerability in a world of mutually assured financial destruction, which could again threaten the IT troubles. The United States should not rashly accept a new form of mutual assured destruction if it can be avoided, he said in a 2009 speech. But is this the situation ushered in the post-epidemic era? Mutual suspicions of global influence and economic dominance have clearly intensified over the past decade. There are also concerns about fair trade, deteriorating geopolitical conditions, and readjusting domestic priorities in the wake of the COVID-19 shock. With the U.S. heading into a general election next year, the anti-China trade stance clearly has bipartisan support from voters. Former Goldman Sachs economist Jim O'Neill coined the acronym BRICE more than 20 years ago to track the rise of large emerging economies. He believes that the relationship between the United States and China would be really catastrophic if it disintegrated on a large scale. Of course, U.S. Commerce Secretary Gina Raimondo's decision to visit Beijing shows that neither side wants a complete severance of ties. China's Ministry of Commerce praised the U.S. removal of 27 Chinese entities from the unverified list as consistent with the mutual interests of both sides. Rain in the cliff? Ren Yongli, an economist at Olixon SLJ Capital, believes that the idea of a complete decoupling is so problematic that it must be calibrated. Issues related to high technology and privacy concerns may be a red line, but China will continue to produce goods to meet U.S. demand and continue to hold U.S. debt. The symbiotic relationship between the U.S. and China is crucial. This needs to continue, or U.S. borrowing rates will rise, Ren Yongli said.